With so many changes in building operations prompted by COVID, we know that our current environment poses many challenges. Our typical operating environment has been upended and does not reflect our current COVID-related impacts to operating expense pass-throughs. Some practices are evolving. So how does one handle operating expense charges associated with COVID-19 and everything related to leasing and so forth? We'll get right into it as we have a lot to cover today. But first, I'd like to thank our two sponsors for their support, Paramount Group, Inc. and Van Barton Group. Paramount Group, Inc. is a fully integrated REIT that owns, operates, manages, acquires, and redevelops high-quality Class A office properties located in select CBD submarkets of New York City, Washington, D.C., and San Francisco. Paramount's business strategy is to focus on the best markets, own the best assets, provide superior talent service, and hire and retain the best people. Paramount capitalizes on opportunity, they cultivate success, and create value, which is their formula for sustained success. Van Barton Group is a privately held, vertically integrated real estate investment and advisory firm specializing in separate accounts for large institutional investors. Van Barton's investments focus on equity and debt credit strategies in major markets throughout the U.S. and spanning the multifamily, office, retail, and hospitality sectors. The firm was founded in 1992 and has corporate offices in New York, San Francisco, and Seattle. We thank both Paramount and Van Barton for sponsoring today's program. Now it's my pleasure to introduce our two guest speakers. First, Manny Fishman, Real Estate Practice Chair with Buchalter. Manny focuses his practice on representing real estate developers and owners in the acquisition, sale, and financing of commercial properties. In addition, he has active leasing practice representing owners of several major office buildings in San Francisco, including the Transamerica Pyramid, as well as tenants in lease and sublease transactions. Mr. Fishman is recognized as a leading attorney in the area of landline and wireless communications and internet-based services in commercial properties and rooftop installations. Manny is a past BOMA San Francisco board member and is active in several BOMA committees, and we're very grateful to have him today. Wes Powell, International Director with JLL. Wes is a landlord leasing broker who has closed over 18 million square feet of lease transactions and assisted with strategy and underwriting assumptions on over $12 billion of downtown acquisitions since 2000. With 29 years of experience representing landlords, 19 of those years at JLL, Wes co-leads the agency leasing practice and is responsible for 23 building, 10 million square foot agency leasing portfolio in downtown San Francisco. He is a past president and past board member of BOMA San Francisco and remains active in several committees. And again, we are very grateful for Wes's time today. So let's get started. If you have any questions, please post them in the Q&A box that you can see down at the bottom of the screen. We'll try and get to as many as we can. And Manny, I'll hand it off to you. Thank you.
Great. Thank you, Kevin. Welcome, everybody. It's a pleasure for both Wes and I to be able to have a discussion with you all about operating expenses in a COVID-19 environment. That's the topic, and we thank Mark Intermaggio for suggesting the program. It's clearly timely, and there are clearly many variables involved. So Wes and I thought it might be best if I just set the stage for several questions. That's what we encourage. I just want to set the stage for some lease language that generally governs how we, as property managers and owners, allocate operating expenses. And so I'm going to use as a base, to say it, a gross lease or a fully serviced lease where there is a base year and landlords bear a portion of that expense in the base year and pass through increases in what Wes and I would generally call a comparison year or a future year. This is applicable whether the lease has a 2019 base year, in other words, that's the first year of the lease, or it has a 2020 base year. Wes and I both think that the real issue is going to be what about leases with a 2020 base year? That's the year where we're going to see so many COVID-related expenses being incurred, and how does a landlord deal with it? So the real issue is going to be what we call a gross-up provision. It's a common provision. And so if you can put it in the first slide there. A gross-up provision is one that tries to normalize or standardize the expenses from year to year. And if you can go to the next slide, here are some examples of a gross-up provision. And what it's intended to do is if a building is not occupied to 95% or 100% during any year of the term, then a landlord has to adjust those expenses as if the building was fully occupied. Because then in future years, people are comparing apples to apples. If we have a unusually vacant building in a base year, then operating expenses in future years will abnormally increase as the building increases in occupancy. But if we load up the base year expenses to what we would call a fully occupied building, and building owners have a bit of a slight difference of opinion whether we should use 95% as the norm or 100% as the norm, and measure year from year based on 95% or 100% occupancy, we at least have a normative form of measurement. That's what a base year lease, a fully serviced lease intends to do. In a net lease or a full pass-through lease where there's really no base year, this concept of gross up is less applicable. And I know if Wes and I have time, we'll talk about whether we think it's beneficial now to move to a net lease or what we would call an industrial gross lease where certain expenses are directly passed through. But in a base lease, it's increases. We try to have a same normative form of measurement. This is the way to do it. Here are two sample clauses. And the key word here is recurring expenses. I want to stop there. Not all expenses that a landlord incurs are recurring. And I would say COVID-related expenses hopefully are not recurring. Hopefully it's something that is an extra expense just in 2020. So if you have a lease, that starts in 2020, some property owners are going to consider excluding that because it's a non-recurring expense and just passing that through in future years if there are some other costs. But for the base year in 2020, and again, Wes and I can talk about it, and individual property owners may take different positions, but it really is an unusual cost that may adversely raise the base year when compared to future years. The next important word in this definition is occupancy. I would say all of us on the call believe that our buildings are fully occupied. And just because tenants may not be actually using their space fully, they are occupying the space. And therefore, most operating expenses still relate to occupancy of the building, and we would consider our buildings 95 or 100% occupied. Obviously, if you had a single tenant building and the tenant was not using it, there might be an argument that it was not being occupied. So those are the two main issues. I think option B as a language is a bit more preferred than option A, but you see many of the either option A or option B language in most leases.
Hey, Manny, if you don't mind, I think this might be a good spot to tackle our first question in the Q&A here, which is specifically related to an equitable treatment of the 2020 base year. And so maybe just to put a finer point on it, specifically, the COVID-related costs, which are non-reoccurring, Would it be correct to say that you could recover those costs in 2020 and then exclude them from the 2020 base year, and then that would be an equitable treatment for both landlord and tenant?
Correct. Thank you for putting it in those words. It is an equitable way to recover it as a pass-through for tenants that have a 2019 or 2018 base year. These are operating expenses that should be passed through.
Thank you, Manny, and thanks to Margaret Duskin for that question.
And I'll be talking about the relative merits of owners and managers making the decisions of on the spectrum of conservative to aggressive, how to evaluate that fairness question, Kevin.
Let me just cover one more point and then turn it over to Wes. Sylvia, if you can go to the next slide. Some common questions. Does GAAP address these? It shouldn't. It really is. Most of these costs are expensed costs. They're not capital improvement costs. Even the boarding up of windows, which we saw downtown, I would say is not a capital expense. It's just an expense. So it should be passed through in the year incurred and not amortized over any period of time. The hand sanitizers, the PP&E, all those things one would think are pass-through expenses. I would expect higher costs in some areas. As I said, the sanitizing, the signs, the floor mats, air filters, and things of that type. Watch for cost pools. There are certain things that just get passed through to certain retail tenants. And I think we talk generally about the vacancy credits. Some leases actually give tenants a credit if their space is vacant, and I don't think that gets kicked in. So I think that kind of sets the stage. And to just conclude, let's remember that gross up provisions only deal with costs that vary with occupancy. There is a good component of operating expenses that are fixed. Whether your building is open or closed, you have to run electricity. 70% of electrical costs, in my view, seem, from what I hear from the experts, are fixed costs, don't vary with occupancy. So let's remember that gross up deals with costs that vary with occupancy. I think that kind of sets the stage and gives you some lease language to work from. And now I'll turn it over to Wes.
Thanks, Manny. Let me, Sylvia, as you get my presentation up, I want to let everyone know that my story on when I was asked to consider discussing this topic with Manny, my first thought was, what's there to discuss? This is not a problem. Operating expenses are a, very clearly defined, easy to understand. We've been doing this for years, and this is not a big issue. I can't tell you how wrong I was in that this is a huge issue. And there's a lot of decisions that have to be made on how you and your landlord address your operating expense calculations for 2020, both in the comparison years and base years. I couldn't have been more wrong. And Sylvia, if you could throw up my deck, please. So if we go to the second page, Sylvia, the crux of the argument is, and Manny addressed this, is that the words occupancy and lease during a gross up, if you read most of your leases, I will tell you they probably say that you have the ability to gross up using occupancy for your variable costs. We've been doing that for years. However, and that's been in all leases. However, what we've likely used in the past is your leased percentage. If you're 95% leased, then you get that in you have a gross up clause that says 100%. You gross it up that remaining 5%. But look at what's happened. During COVID, you could honestly say that my building, even though it's 95% leased, it's only 10% occupied. And so per my lease, I can now gross it up 90%. I can almost double those variable costs. And that's the crux. You have to look, there's going to be a number of decisions that you make. There's many right decisions based on your building, your ownership, your ability to follow along the spectrum of conservative to aggressive. Know that as you're looking at these issues, when you look at your costs, your methodology in the past, you've probably had methodology consistency for your calculations. It's usually a good thing. But however, if you use that consistent methodology, that will unequitably hurt or help one side, one party in virtually all leases. And this is all due to the COVID shelter in place. This is what makes this such an interesting issue. As Manny said, I want to say this last point is that COVID-related costs are an operating expense cost. Yes, we should be putting those into operating expenses. Please check your lease. I saw one lease in preparation for this that actually had language that specifically excluded this type of extraordinary cost. So some of your bigger leases, more sophisticated leases, heavily negotiated and/or negotiated during a downtime of the market, might have some kind of limitation for the extraordinary costs.
Wes, you said something that I want to emphasize. The biggest one big risk from a major tenant would be if you are inconsistent in your application of variable costs from year to year. As Wes and I will talk about later, is there a risk of increased audits? We can talk about that.
Yeah, we'll definitely talk about that. Next slide, please.
The first thing a lawyer is going to point out to you is you're inconsistent in applications. So Wes's point about consistency needs to be taken into account.
So this is how you'll have to, focus the way you approach your operating expenses this year is that the whole history behind a full service gross lease and operating expense pass-throughs is a concept that fairly attribute increases for both landlord and tenant for any costs and any savings. But look, this year, you could say that because we have this occupancy in our leases, yet even though we've been doing it per a lease percentage, look, Mom, there's a magic trick. I can make my operating expense calculation to make my landlord money. It's magical. If we gross up the actual COVID-related low occupancy in 2020 and some lower operational costs, I see that Jenna Hattersley asked a question. Hey, we have some savings in HVAC, electrical, maybe even janitorial. We're going to have some low variable costs. And if we gross those up with occupancy, I can almost double my variable costs. If your property is 5% occupied but 95% leased, you could probably almost double that. And so if you're using that, it's almost like a magic trick. And now, what if you're building, and that's for any comparison year, and there is no trick to this really, that yes, you're going to make the landlord more money and you're going to have a big recovery calculation at the end of the year. Conversely, if you're building a base year for a tenant who has a new base year, new tenant coming in, a renewing tenant with the 2020 base year, you could build a base year by possibly cutting those COVID-related expenses out, and two, maybe you're just using and taking those non-grossed up, low occupancy numbers, and that's going to give you a built low base year, so that all comparison years you're going to make money throughout that term for the tenant. We want to talk about the fact that there's no magic trick to that. Yeah, that's the way the calculations work. But let's assess the risks. If we go to the next page, please. There's tricks and traps to, thinking that I could, and no awards given to someone who simply says, I can figure out a way to make this calculation work to one side or the other. But we have to figure out what the right decision is for your building. And so before, we'd suggest that, as you have this, opportunity to build, and calculate your operating expenses, before you determine it, your methodology, you have to fully ascertain, evaluate a number of issues because they will come into play. They should be discussed, understood, agreed upon amongst your team, your accountants, your senior management, and your owner. And it's really, how do you construct your 2020 methodology this year, maintaining a defensible consistency? Manny just mentioned, as a lawyer, he's going to jump all over any variation from consistency. Now, if you're consistent using a lease percentage, versus an occupancy percentage, that could change completely. You have to look at it also versus the spirit and intent of the operating expense clause. Even though they're often highly negotiated between a landlord and tenant, the spirit and intent of this clause is the rationale is to fairly and equitably share increases in expenses over the term. And so if you put the methodology that you've used in the past, maintaining whatever you decide to do, a defensible consistency, and then the idea of quality, you have to evaluate that. Should you change your methodology? Because now if you may, your methodology you've changed may hurt or help one side unfairly. You need to know what that reason is, who it helps and why. You should test the impacts of any methodology changes for both materiality and equity in the operating expense clause. Next, Manny mentioned disputes, audits. You have to understand and accept that if you and your landlord take the aggressive methodology, yes, there's a way to probably make a little bit more money or a lot more money on your building by changing methodology to help your landlord. That's, and you might say like, well, Wes, Manny, that's what we do. We make money for our clients. Yes, we do, and but we want to balance that with not walking right into problems, because you might imagine if a large building or a large landlord, large portfolio, went maybe too aggressive on their approach on the methodology, made changes, did the calculation in a way that certainly helped the landlord, but was so inconsistent and utilized the COVID issues and the shelter in place to help one side, maybe the landlord, improperly. Mark my words, there will be disputes, there will be audits, and these will come right after starting to come right after you deliver your 2021, April, May 2021 reconciliations for 2020 for all your comparison, your tenants. You have to understand these will likely take place. And if there are risks like that, and I remember a building, I'm old enough, 30 years in the market, I'm old enough to remember a building in town, the landlord's no longer in business. They took the books on their operating expenses. One tenant disputed, it got around, every tenant disputed, went into a big major lawsuit, and that landlord ended up having to pay tenants for all these back operating expenses. And it really affected the marketability of the building. Their vacancy went up, their lease rates went down, and they just basically had a bad reputation. So as you discuss the changes that you intend to make with your building and where to balance what's right for the building, you have to assess any reputational risks for the marketing program, the landlord, the building, and the management company, your accounting and management company. So in summary, we'll go to Q&A here shortly, but the interesting thing about COVID and operating expenses is that what should be a very easy, we've done this way 1,000 times before, really has become an interesting issue because of this occupancy versus lease percentage gross up calculation. So with that, we'll open it up for any other comments or Q&A.
Wes, there's one question that you and I talked about, and let's just kind of focus on it. Do you think the gross up provision applies to a triple net lease? In other words, some building owners just do net leases. Do you gross up in that situation? Does the gross up apply?
Well, So triple net leases, for an industrial triple net lease will be a little bit different than a commercial high-rise multi-tenant commercial net lease. The answer to that is the lease language will say whether it allows it. A commercial office building multi-tenant net lease may allow for some gross-up provisions. A single-tenant industrial triple net probably will not. So you'd want to take a look at the lease language that's consistent throughout the building.
And I would just add, it's hard to envision if you're trying to do a net lease, which is actual costs passed through to tenants each year, how you would gross up certain expenses, but there could be some unique circumstances. And the other question we might want to address, Wes, is the estimated monthly payments. I'm getting questions from some tenants, should I approach my landlord to adjust my estimated monthly payment? Because as we've heard, some costs are going down. Do you think it's a valuable thing to do, or you're going to end up paying it at the end?
I think it's fair to say that most landlords prefer not to adjust mid-year. There has to be an extraordinary situation. And look, the pandemic and COVID is extraordinary, but most owners and management companies don't want to do a mid-year adjustment. It is possible, but look at the situation that we face. Yes, some costs are down. However, if we look at the calculation methodology, we can make, if we use the lease language that says occupancy, even though costs are down, we may be able to fabricate a proper, calc. When I say proper, the math works to actually adjust it up. And so while a tenant might think they're getting a discount because the building's not very occupied, the calc could work out that actually would be an increase in the mid-year re-reconciliation, and to reset that mid-year. So that's the biggest, most interesting issue that we're facing.
Right.
Yeah, and Wes and Manny, on that topic, Tani put a question into the chat box about understanding the difference between leased and occupancy, and I think you guys spoke to that very well already. But I guess in short, is the most equitable answer to continue your consistency in your methodology, and then understand those terms as they're applied in the lease language?
I would say definitely yes. I think it is. I think it's aggressive to try to have a false base year by excluding certain costs on the hope that you can then pass it in to future years. I think you need to have a consistent basis of what are your recurring costs that relate to occupancy, and those have to be adjusted and not start playing with that from prior years.
And look at that. If we talked about how you could possibly build a base year for any tenant who has a new base year that will be a little bit artificially low or low, while you might also have a number of tenants who are going to be riding on a comparison year, 2020 comparison year. What if on that base year tenant you ever get audited and becomes a big dispute, or they happen to find out from their neighboring tenant that their 2020 base year was $25 a foot in OPEX, but your 2020 base year, their comparison year is 25, but your base year was 20. That's a hard discussion to talk about with your integrity card intact, right? Now, with that said, there might be very easy things around the edges. Maybe the COVID costs shouldn't be in a base year when you're building one. Maybe they should. There might be things around the edges of that. But that's going to be a big issue that all owners and managers tackle as they're putting these together.
From in advance of this program, I did speak to a auditing firm that I've tussled with in the past, and on the theory that you should always keep your enemies close. I talked to him about this, and his view is we anticipate higher demand for audits is starting in 2021. So, this is not, careful how aggressive you get, because I think the Fortune 500 companies are attuned to this issue.
Yeah, I was going to say is that, you know, my slide that said, look, mom, a magic trick. Everyone on this call is landlords. You know, we're working on behalf of our clients and our investors and shareholders and our job is to make the most money possible. But this is one of those things that really, you know, comes into, it's a great opportunity to test where that, you know, most money and right thing is. And, you know, there's no one who can say exactly what's right for you and your building. And we don't, you know, we don't profess to know what's right for you and your building. But, you know, balancing that with the fact that if you're too aggressive, we know there will be problems. If you think that you're a building who can sneak this by, I would say you're wrong. As Manny said, there will be, this is not so tricky that there won't be smart people on the other side of this trying to catch people who took this too far or didn't do it correctly or made a mistake.
Right, and just continuing down that line of thinking with setting the 2020 base year, you know, from a tenant's perspective, what might they expect from the landlord, you know, on non-traditional adjustments, or will they expect non-traditional adjustments to that base year in order to get the, you know, these reoccurring variable costs back to, you know, a traditional trend?
You know, actually, I think one of the best areas that a broker could assist a tenant is to put something in the letter of intent about what's going to be included and what is excluded for base year expenses. Just how we all know the brokerage community dealt with gross receipts taxes and commercial rent taxes. So this is an opportunity for the tenant brokerage community to try to highlight this.
Is it appropriate for me to make a joke that a lot of tenant rep brokers may not understand the complexity of some of what we're talking about?
No, you're not allowed to say that.
But look, as soon as one person catches on, it will happen very quickly, and we would expect that the fair and equitable agreement between landlords and tenant rep brokers will take place. There's a lot of very sharp tenant rep brokers who will catch, not catch on, but are able to determine this, as we speak.
Another question that's kind of come up is caps. A lot of times we are either as landlords, well, because of the market and because of the leverage that a tenant may have, there is a cap on the amount of increases in operating expenses year to year. And Kevin and Wes understand the nuances of that type of clause, but nevertheless, sometimes there are things excluded from controllable operating expenses that are subject to the cap. I urge everyone to look at that clause again to make sure these type of expenses are not included in the cap. And we never had thought about that before. So some caps may inadvertently not include this as an uncontrollable expense. If you're doing an amendment to a lease, now's the time to look at it.
Yeah. Yeah, I see that question, and look, I think most tenants won't have a cap. I mean, you're really going to have that cap typically on a very, very large lease, but most tenants probably won't have that.
And a question in from Sarah McIntyre that I think dovetails well here, which is, what if the COVID-19 additional expenses, HVAC filters, cleaning specs, et cetera, are here to stay, not just for the next 12 to 18 months? And wouldn't a tenant then have a fair argument that those expenses should be included in the base year?
I'd say yes.
That's a very good comment. And I gotta admit, I've always assumed I'd want to exclude it, but if we really are entering into a new period where we're going to get these type of viruses every 2 or 3 years, and what we see is temperature testing, PPE, and hand sanitizers are a common expense, it's a good point.
Hey, Margaret, great. This is a great question. We haven't even thought about this, but Margaret Duskin asked about the advantages of an IG lease, especially helpful, things that are net of electric. And interestingly, because an IG lease now, you're not going to be grossing up any of that electrical because it's a direct charge back. So this is a point where that the actual electrical cost is down for that one tenant. The landlord's not able to gross it up, whatever methodology, by lease or by occupancy. And so the tenants with that IG lease, that's an advantage for them. It's going to be, it is an advantage for them in the current scenario for 2020. That's interesting. IG leases are advantageous to the tenant during this period.
Wes and I have had this ongoing conversation. Is it favorable to move to a net lease, a base year lease? And I think Wes's view is the IG lease is probably the more, if you're going to consider a move, consider the move to IG, in part because of what Wes just said, but in part also because 70% of these electrical costs are fixed. You got to light the common area anyway. You got to clean most bathrooms anyway. So, it really does isolate the costs to the landlord and isolate the costs to the tenant.
This is kind of an age-old question of which is better, the full-service gross lease or triple net or something between like an IG. But our capital markets group did a lot of studies and analysis on this, and basically what it came down to is that an IG or full-service gross lease creates a little bit more value, a little bit more cash flow for the owner, and basically it's because you're getting your rent increases, your 3% increase, not on that triple net, rent, which is the less the OPEX. It's on the full. It's the higher portion of the rent. There's pros and cons, but generally that was the analysis kept coming out, and no matter how you ran the sensitivity on it, that triple net leases were slightly less advantageous that way. Now, with that said, there could be some advantages if you have high vacancies for landlords, but sometimes not. But that's an age-old question. 20 years from now, they'll be asking the same question.
A question in from Laurel, Washington, and I think this has like an equitable treatment angle to it as well, which is, and it's a strategic question on an asset-by-asset basis, but would you suggest increasing spending at the end of the year to minimize giving back estimated reimbursable credits, although there is a percentage of tenants that may not end up paying on that or disputing?
Wes?
Yeah, I'll take it. So that's another great question. It has to do with, there's no glossing answer for this. It has to do with your individual calculation, an OPEX, an old asset management or property management trick is model your OPEX calc in a spreadsheet and take a number, deduct $100,000 from it, see what happens to your recoveries. Add $100,000 to it, test it out, see what happens to your recoveries. There may be some R&M items, repairs, things you want that you should strategically put in to maybe manage that number. That is something that a very smart portfolio or asset manager or property manager would do if you understand how that works. So that's a good question. I can't answer it, Laurel, on any one asset, but that is something that's black belt level property management, budgeting, OPEX recovery work. Yes.
Kevin, from monitoring the Q&A, and I know you're asking the questions, I'm getting a sense, and Wes, if you're seeing the same thing, that most property managers are expecting 2020 expenses to be artificially low. That was, Ann has noted that, Montilla. But is your sense, and all of you, that 2020 expenses will be low?
Kevin, I think you told me earlier that overall we would expect them to be lower than past years. There's been a lot of, it's simply because our occupancies are lower. This is actuals. Manny, I think if you answer that question is, will the OPEX calculation, the whole purpose of this webinar is, if you talk to a tenant, you could tell a tenant, no, they're going to be the same, or they're going to even be higher. That's the crux and the interesting thing about the COVID-related issues surrounding OPEX. But I think, generally speaking, portfolio-wise, actual expenses will be low. And Kevin, do you concur with that?
I do. I think kind of wherein the rub lies is that, cost control has been an important topic for property managers across the course of the year, not only for their landlords, but for their tenants. And then now that we arrive at the end of the year and there's a reconciliation process with contract language tied to it, what is the equitable way to treat it? And I think that's, the rub and the crux, just as you said, Wes.
Mm-hmm. Another good question MIT asked, is there if there is a real expectation that a 2020 base year will be artificially low, for tenants with a 2020 base year, what's the advice for requesting adjustments that said, this is coming from someone representing tenants, Ann's a broker, so she said, what's the advice for requesting an adjustment such that they're not paying an inequitable amount in the future comparison years? Very good question for a broker. And I'm a landlord broker, as you know, and we work together on some deals. That's a very good question. I would expect that sharp tenant rep brokers will understand this, figure it out, and if they don't during the LOI negotiation, their lawyers will and business people will figure out that, hey, we need to make sure that, while the landlord could aggressively set this up to inequitably help a landlord or aggressively help a landlord, the tenant side is going to want to try to balance that out or try to inequitably help the tenant or unfairly help the tenant. So I think that we're going to go through a year or two of negotiations in the leases and the LOIs that bring that to the middle fair ground.
Another question in here from Laura Millett, I apologize, from Iris Rodriguez. Would it be fair to gross up the 2020 janitorial and electrical expenses to a previous year cost?
I like that suggestion a lot. In other words, there's a common lease concession that some tenants ask for, which is to say that if you have a new policy in a comparison year that was not included in the base year, you need to insert something in the base year for that cost, and you can increase it by a rate of inflation. So to take that as a comparison, let's use for janitorial costs what we had in 2019 and increase it by some factor. And I think that is a consistent methodology from what we've been doing in the past. It's an equitable way to do it because it's a cost that varies with occupancy, and the way to gross it up for 2020 would be to use 2019, a normative year, and move it into 2020 with some 3% or whatever labor costs there are.
Yeah, so that's a great example of a building, a manager who's is considering, how do we slightly or in a large scale change the methodology. So if you're doing that, if you're changing methodology, you have to evaluate the relative merits and how it's going to be looked at. That sounds very logical to me. It sounds fair to me. But you have to look at it relative to testing out the materiality and the how it goes against the rationale of operating expenses. If it's just done to help one side or the other, you might want to rethink that because it is subject to disputes in the future. But I think on the face of it, generally speaking, that's a fair thing to do.
One question that has come up is what to do with operating expenses relating to responding to a COVID-19 positive test from a tenant. Is that a extra expense passed through only to the tenant? Is that an operating expense for the building? That's something that I think many people are going to need to address. It is a nuanced issue, because if you have a tenant on a multi-tenant floor, it's hard to say that cleaning the bathrooms on that floor was just for that tenant. It really is the benefit to everyone. So one has to work through that issue. If you had a multi-floor tenant and you had to respond just to that tenant, you might be able to push some costs just to that tenant. But there's no great answer. But you've got to think that through in figuring out what is a building common area expense and what is I'll call it a cost pool or an extra expense to the tenant.
Yeah, I agree. I don't know if the question said that they're actually testing for COVID. I hope it's cleaning for COVID. I hope buildings are not, putting swabs up people's nose to do COVID testing. That's above my pay grade. But yeah, it's going to be a nuanced thing of, like Manny says, of cleaning costs. Yes, extraordinary cleaning costs, attributed to one tenant's activities. That might be something that could fairly be charged back to the tenant.
Another question in here, Wes and Manny, relative to a strategy for non-cumulative caps when the asset has reduced expenses in the retail pools.
Wow. Non-cumulative caps, got it, applicable to the retail pool.
Yeah, I would say that, look, I would run that calculation with your standard methodology. Look, that we should not have problems as landlords that if there is expense savings, that tenants are going to, share that. It may not meet our budget that we put together in 2019 because we didn't know about COVID. A savings is meant to be shared. So I would say that I'd run it and test it for not just materiality, but fairness and equity, and that yes, there might be lower cost pools that end up benefiting some tenants. I think the idea that we can't have that is wrong. I think there will be savings. That's the whole idea of operating expense clauses. Manny, do you agree?
No, I do. What struck me is the importance of this topic is not just for 2020. It really is a compounding problem, because what we do now for a 5-year lease is going to compound. So we've just got to make sure we address it, which is what that non-cumulative cap thing just all of a sudden said. That's why, we should have cumulative caps. But yes.
Yeah. We have a couple of questions that are coming on about, look, some costs are down, some costs are up. They might come out to be the exact same, which is great, which is fine. If you ran your traditional leased percentage gross up, you're not going to have a material difference. However, if you decided to go with for your language in your lease, and if you change methodology to an occupancy-based gross up, then you're going to be building up a big 2020.
Wes, Kevin, one question I got was, if you have a tech tenant that has told its employees you don't have to come back to mid-2021, what impact is that having on operating expenses in the building?
Are you saying that a building is only 10%, it's a 95% leased building, but only 10% occupied? What does that do to a building's OPEX generally?
Yes.
Kevin, didn't we discuss that that's probably a plus minus $2 per year savings? Is that what we discussed in actual costs?
Yeah, something in that realm. And I think the reality is that in order for most of our landlords in the city here to keep their buildings open, they have been providing building services to all of these spaces. And the language in your lease surrounding your requirement to provide those building services in order to be, is really important. And so that's potentially where that lies.
Agreed. It goes back to our base concept of 70% of all of our expenses are generally fixed. Whether that you got one employee there, 10 employees there, or it's fully staffed, you have to provide a certain level of HVAC, electrical, and it's a fixed cost.
Yeah, I think many buildings who don't see a lot of actual savings through this because there's offset costs that could have into it. But I think I have seen and heard of a number of buildings who are getting plus minus $2 a foot in actual savings during this.
Yeah, and there's a lot of specific costs that can be driven by the construction of your building too, with how you have to take on COVID costs. And so some buildings may be seeing a net due to the fact that they have these increased COVID costs, maybe lots of large common areas, lots of high touch areas with this new cleaning ordinance. So each building is going to be a little bit unique on what they might see from a cost impact this year.
I've seen a number of buildings that the increased cleaning requirements due to COVID rules actually didn't increase because they were able to handle it with the existing janitorial team and protocol. So it actually, I've seen some buildings that it hasn't increased, and I've seen others that has.
If we have a moment, I've got more questions, but if we have a moment, there is a topic of the force majeure clause, which is not directly related, but it might be useful to just have people look at that. I've got a slide on that, but we've got about 10 minutes, so if we've got more questions, that would be great.
And Sylvia, I don't know if you're seeing any more questions on your side. I think we've addressed everything that's in the Q&A, but please feel free to add them in if you have any questions.
No more questions.
So Sylvia, if you can go to slide 7 on mine. I just want to spend a moment on force majeure. It's become a topic du jour because tenants seem to be relying on it. This is a poorly drafted force majeure clause, and I use it because it's common in leases. We never really focused on it. And it just says, look, if I can't perform because I'm prevented from doing so because of a lot of reasons, and it even says inability to obtain materials, services, or financing or acts of God or government regulations, I'm excused. And the only exception is other than the payment of money. That is supposed to cover the payment of rent. It's not clear enough. So I urge you all to look at your force majeure to make sure tenants are not able to argue, which they will, that they were not able to pay, they should be excused from paying rent because the San Francisco shelter-in-place orders required them to close. And therefore, there was an act of force majeure attributable to government regulations, acts of God, or inability to maintain certain services. We need to focus on this to make it a little bit better. And one of my answers to you is to try to look at what I have on slide 8 and 9, which is language that says that the obligation to pay rent is independent of every other obligation. You gotta pay rent. And you need to kind of cross-reference that in your force majeure language. It'll get rid of a lot of problems. Now's the time. You're entering, we've had a pause in new leases. We're gonna start new leases. Let's look at our force majeure so that if, unfortunately, this continues, we don't step into it. The input I can give you from monitoring litigation in San Francisco is that major landlords are bringing suit against major creditworthy tenants. And the first line of defense that a tenant is raising is, well, my force majeure clause is a little vague, and I had a government regulation that prevented me from operating business, therefore I should be excused from paying rent. Not a great argument. We have defenses to it, but it's what tenants are saying. So I did provide you with some language, and I urge you to look at that clause.
Thank you, Manny. Well, if there's not any more questions, I would like to extend a very big thank you to our panelists, Manny Fishman and Wes Powell. Great job tackling a topic that is nuanced and does not have that magic answer as Wes alluded to earlier. We very much appreciate learning from you today as we navigate through this new budget season. I also want to thank Paramount Group Inc. and Van Barton Group for sponsoring today's webinar. We value your ongoing partnership, and thank you for joining us today.
Thank you. Bye-bye, all.
Thanks, everyone.